Good morning, everyone. Can you hear me? So, we will continue. Yesterday, we had finished bond valuation part. Now, within bond valuation, just confirm question number 29, 30, 31, 32. These four are only left now. Just check once. 29, 30, 31, 32. Everything else is completed. Okay. So, in the notebooks, therefore, now please give heading. What will be the module number now? Module number. New module, if I want to start, what will be the module number? Okay. So in the notebooks, please write down module 10 and give heading money market instruments. Money market instruments. Two sides. Money market instruments. Everyone ready? Okay. So, I think we have already discussed in Forex what money market instrument means. Money market instrument refers to any kind of investment or borrowing that one does for a period less than 365 days. More than 365 means it becomes capital market instrument. Less than 365 means money market instrument. So if you want to invest for, let's say, 360 days or maybe 91 days or 181 days, 182 days, whatever. So basically you want to do any kind of lending borrowing for less than a year, then that qualifies as money market. Why is the need to qualify and all? It's okay, no, it is necessary, because if you are money market instrument, then you are governed by RBI. If you are capital market instrument, you are governed by SEBI. You are understanding? So this what we are studying here are RBI governed securities. All money market instruments are zero coupon bonds. Okay, none of them are coupon bonds. They will issue at discount and redeem at par. That's the whole story. And all of these money market instruments are subject to credit ratings. Means people like companies like CRISIL and all will give credit ratings to these bonds, and depending on the credit rating, there will be yield. Okay, so if high rating you get, then you will be able to issue at a lower yield, and if low rating you get, you will be able to issue at higher yield. That's how money market instruments work. Okay, stamp duty, registration, everything you have to pay. Now students, as far as money market instruments are concerned, I'll tell you there are 6-7 of them. So you don't write this, just understand. One is called as call money, other is called as notice money, third is called as treasury bills, fourth is called as certificates of deposit, fifth is called as commercial papers, sixth is called as commercial bills, seventh is called as repo and reverse repo. 7 are there. Now, call money and notice money. We'll talk about these two first. Call money and notice money are basically short-term instruments. See, do you realize in money market instrument there will be one borrower and one lender? Everyone clear? The one who is borrowing is the one who will issue the securities. You are understanding now? And the one who is lending will be the one who is buying those securities. Is that clear? Just if this distinction is not clear, now remember debentures. The company issues debenture, investor buys debenture. Now the one who is issuing is actually the borrower and the one who is buying the debenture is the lender. Okay. So in call money and notice money, the borrower and the lender, the issuer and the purchaser of securities, both are banks. Okay, interbank transaction this is. Now, if a bank issues a short-term security with a maturity period of only 1 day, single day, 1 day instrument, then it is called as call money. If it is from 2 days to 14 days, it is called as notice money. Okay. Now, why you are saying, why would someone issue for 1 day? It is very simple. See, like for example, I am HDFC Bank and Tanisha has account in HDFC Bank. She has opened FD. Now, let's say she has 10 lakh rupees FD. Suddenly one day, because of some emergency in her life, she comes to break the FD and withdraw money. Can she do that? Yes, she can. But it is possible that I am not ready. Your understanding, as a bank, I had thought that you will come on your maturity due date. Suddenly midway if you come, then can I say I will fall short of money, and then I will say, okay, I will be able to arrange for the money, but I will take at least 1 day more. But in order to fulfill my commitment to Tanisha, I will have to give her the money. In that situation, can I say I will borrow from ICICI Bank for 1 day? You are able to understand like this? I will, as a bank, I will borrow from another bank so that I can give Tanisha her money. And then once I am able to arrange my own money, I will repay the loan taken from ICICI Bank. So that is call money. If you are doing for 2 days to 14 days, same situation, then it is called as notice money. What other emergencies could happen? FD is being broken, or suddenly people want high levels of loans from us. Our customers are only increasing, they are wanting loan, but I don't have cash. Yeah, for whatever reason, okay, for whatever reason, I need, as a bank, I need money emergency, and I at that particular point of time don't have, or like this also can happen, that I was supposed to get money from Mahalakshmi and that money I was supposed to give to Tanisha. Correct? Tanisha did not come early. Tanisha came on time only. But Mahalakshmi did not give her money on time. That is also possible. You are understanding? So there could be multiple, it's a money business, anything can happen, and due to that there could be requirements for the bank to arrange for money in a short span of time. Then these people will not go around issuing equity shares for that. You're understanding that, oh, I will issue equity shares, I will raise more money, or bonds and debentures. No, they need money only for a very short period of time. Hence these instruments were born, call money, notice money. As of today, both call money and notice money is called as call money only in the world outside. But on paper there is a distinction. 1 day means call money and 2 to 14 means notice money. Everybody clear? Now, point number 3. Treasury bills. Now, treasury bills are short-term instruments, short-term zero coupon bonds issued by government, central or state, both are okay. Any of them are issuing short-term securities, short-term instruments, short-term bonds to the public at large, to institutions, corporates, etc., through which the government can raise money for a short period. Okay, then students, it is called, then that instrument is not called as a Government of India bond, it is called as a treasury bill. GOI bond, Nitin Gadkari wants money to build a road from Mumbai to Bangalore. Now that road he wants to build, he needs, let's say, 1,000 crore rupees. That 1,000 crore he will not take from taxes, he will raise money through all these instruments only. But then when he is raising, he will raise something called as infrastructure bonds and government bonds. Those are big ones for long period of time, 20 years and all that. Then for 20 years the government will charge toll from people, and from that toll the interest and principal is paid off to the people. That's how it happens. But government could also need money for short term period. Then for short term, if they want, then they will go for treasury bills, not the long term bonds. Everyone clear? Okay. Similarly, students, this whole concept is there in that remove government and put bank. Bank is issuing securities of maybe 3 months, 6 months, 364 days, etc., less than 1 year basically, and bank is basically raising money for that short period of time. And bank is not now taking from another bank, they are taking it from general public and other corporates and institutions. The normal bond they are issuing, but not a long term bond, a short term bond. Then those bonds are called as certificates of deposit. Everyone clear? Similarly, so if government issues short term security, they are called as treasury bills. If a bank issues short term security, it is called as certificate of deposit. If a normal company issues short term security, it is called as commercial papers. Your understanding? Simple to understand, no complication. Same, just the issuer is changing. Okay, how do I remember that who is for what? It's very simple. See, it is very, very famous. There are treasury benches in the government, correct? So treasury, Nirmala Sitharaman, correct? She is heading all this. So do you understand that treasury department of the government? So treasury bills will not be issued by treasury. This word will not be used by banks and companies. It is basically a government terminology. Deposit, withdrawal, deposit and all this happens with government, company or bank. It happens with bank. So when we talk about certificates of deposit, this is how I remember it has something to do with banks. Everyone clear? Bank is issuing that. And commercial, I think you understand, it is talking about companies. Everyone clear? Simple not to understand the names. Names in a sense, whom does each one belong to, like that. So treasury bills done, certificates of deposit done, commercial papers done. Now students, comes commercial bills. Now commercial bills are basically your bills of exchange. Okay, so I have a bills receivable with me. Let's say I sold goods to Mohammed worth rupees 1 lakh. I have a bill receivable of rupees 1 lakh. I go to bank today only and I do bill discounting process, and bank gives me 93,000 rupees, for example, today only. Correct? 7,000 is the interest of the bank. Now students, do you realize this is also a short term security? Just think, can I say, I the company, I am borrowing 93 rupees from bank, bank is lending 93 rupees. Eventually, I am paying 7,000 rupees interest because I will be repaying back 1 lakh when Mohammed gives me my money. Bank is investing 93 and the 93 grows to rupees 1 lakh. Can I say again the borrowing lending process is happening here also, and hence all your bills of exchange like bills receivable and bills payable are also considered as money market instruments. Everybody clear? Done? So tell me, in call money, call and notice money, who is the borrower, who is the lender? Both banks. Both side banks, 1 day to 14 days. Treasury bills, certificates of deposit, commercial papers, lenders could be anyone. You're understanding? It could be banks, it could be other companies, it could be institutions, it could be general people at large. But the borrower in treasury bills is government, in certificates of deposit is bank, in commercial papers it is company. In commercial bills, bills of exchange, if it's a bills receivable meaning the company is supposed to be receiving money from customer. In that, if company goes and does bill discounting with bank, can I say bank becomes the lender and company becomes the borrower. Everybody clear? And the interest is, it's a zero coupon bond. I hope you're understanding. And when the customer will pay money to the bank will take that money and give it, when the customer will pay that money to the company will take that 1 lakh rupees and repay it to the bank. Everybody clear? So in that is again another money market security. 6 done. Everyone clear now? Hello? Following or not following? Clear, na? Okay. Then comes repo and reverse repo. Anybody knows about this? Reverse and repo and reverse repo concept. Yeah, bank and RBI, very good. So what happens is, this is RBI and this is HDFC Bank. Now RBI is the big brother, HDFC Bank is the small brother in this particular situation. Now let's say HDFC Bank wants to borrow 100 crore rupees, okay, from RBI. RBI will lend, no problem. But then RBI will say, you should give some kind of security to me. You're understanding? So now in HDFC Bank's balance sheet, okay, there must be some long-term investments here. Within those long-term investment here, there must be some kind of securities that they must have purchased. HDFC Bank will have to take those securities, okay, they will have to take those securities and give to RBI. I hope you're able to understand. Give to RBI as a security deposit. And then students, once HDFC Bank is done with this 100 crore and the time to repay is there, at that time HDFC Bank will repay 100 crore plus the interest back to RBI, and RBI will give back these securities back to HDFC Bank. Everyone clear? Simple calculation. Done? Everyone? And of course, based on the market value of those securities only, the loan will be decided. Which means, do you realize that if 100 crore rupees loan HDFC Bank is wanting, it has to give 100 crore rupees market value of securities to RBI as a security deposit. You cannot give 5 crore rupee deposit and ask loan for 100 crore. That is not possible. Correct? Now, why it is called as repo? Repo. Because do you realize here HDFC Bank is initially, yeah, very good. Yes, it is initially selling the securities to RBI and then repurchasing it back. So it is basically a repurchase agreement. It is a sale and repurchase agreement. Repurchase in short has been called as repo. Everybody clear? Sale and repurchase, like that. And students, if reverse is there, reverse means RBI wants loan from HDFC Bank, then it is called as reverse repo. Everybody clear? It is called as reverse repo. Everyone following till here? Clear? Now students, as far as all of this is concerned, this in 2020 when the module was amended, ICAI put all this information. Okay. Yeah. See, refunding of bonds. One small innocent looking paragraph. Bond refunding, you remember this? Okay. Money market instrument. So they have given this whole paragraph, this whole theory to you, and I would recommend let us not write any separate theory for this. Everything is there. See, money market instruments, intro is there, call and notice money is there. See, they are referring to both call and notice money as one term only, call/notice money. But then can you see second paragraph? When money is borrowed on overnight basis or for one day, it is termed as call money. However, under notice money market, funds are transacted for a period between 2 days and 14 days. Everyone clear? So this is basically your call notice money. Treasury bills, as I had discussed with you, is being issued by government. Treasury bills, first paragraph, last line. The treasury bills are short-term promissory notes issued by Government of India. At a discount means basically zero coupon bonds. Na? Everybody clear? Issued at discounts. Then commercial bills. Commercial bills are issued by corporates, by companies. Correct? I'm sorry. Commercial bills are your, they are not commercial paper, sorry. Commercial bills. They are the bills of exchange. Everyone clear? Bills receivable kind of thing. So those are your commercial bills here. You can see first paragraph, third last line, end. A bill of exchange is a self-liquidating paper and negotiable. It is drawn always for a short period ranging from 3 months to 6 months. This is basically the bills of exchange point here. Then we have got certificates of deposit. Certificates of deposit, I hope you remember, is issued by banks, correct? So, hello, everyone remembers, no? Certificates of deposit issued by bank. Commercial papers issued by corporates. Lot of now you can look at the data given by ICAI and it very clearly appears as if it's some copy paste from some kind of Google search. You're understanding, a lot of unnecessary data is given that in this year that committee was set up, this and that. Anyways, so commercial paper, repo and reverse repo. Everybody clear? Repo and reverse repo. So the term repurchase agreement and reverse repurchase agreement refer to a type of transaction in which the participant raises funds by selling securities and simultaneously agreeing to repurchase the same after a specified time, generally at a specified price. Everyone clear? Point number A, repo rate is the rate at which RBI lends to banks. On the other hand, reverse repo is the rate at which banks lend to RBI. First point, you can see that. So all that is there, students, and the remaining points are all economics and macroeconomics and all that. We will skip all that. Everyone ready? So with that, students, we will now move on to the remaining questions. So in the notebooks, what you should write is money market instruments you have written. Just write refer theory from ICAI module. They have given much more in detail. Refer theory from ICAI module. Refer theory from ICAI module. And students, the sums are so simple, no? Nothing. Very, very simple questions. Come to question number 29. Already? Pranav, yes. Okay. So, what are they saying? RBI sold means issued a 91-day treasury bill of face value 100, which gives the investor a yield of 6%, return of 6%. What was the issue price? Now students, wait. I'll just tell you something here. Question number 29. Let issue price be X. Correct? Students, do you realize that face value or redemption value is 100? The period, okay, the period is 91 days and the yield is 6% per annum. Now imagine you buy this particular bond. Okay, do you realize that the only return you will be getting will be 100 minus X? Do you agree? Take your time. The return that you will be getting is 100 minus X. As a percentage, your return will be 100 minus X upon X into 100. Do you agree? 100 minus X upon X into 100. All following? And do you realize that this return that you are getting is a return for 91 days? So then if I want to find annualized return, can I say I'll do into 365 by 91? And this, do you realize, is 6. Understood? Okay, solve it and get X. Start. Question over. $98.5253. Okay, 98.526 it is now. So 98.53. 98.53. I think Institute has presented it exactly same like us for a change. Na? Just check. Done? Alright. So 98.53 we have completed. Students, complete question number 31 on your own. It looks bigger than 29, but trust me, it is the same size. It's a replica of 29. I hope you are understanding. So what was 100 in the previous question is 10 crores here. What was 91 days in the previous question is 91 days here. What was 6% in the previous question is 12.04% here. 365 will remain 365. You can do rupees in crores only, huh? Don't open it up. That much money don't have. $9.71, around that number you should get. And as usual, institute has done something else only. They could have normally done how they did this one, no, but they did something and they got this. Then they are also saying you can do present value calculation also doing discounting, compounding, but it's okay. We'll stick to this. No need of alternate. All done? 9.71. Okay, let's now go to the next question. Question number 30. Alice in Wonderland. You have read this story in childhood? Alice in Wonderland, Mad Hatter, someone, Mad Potter, someone was there, no? Different characters. I forget the story. And what was there? 7 dwarfs. It was Snow White and 7 dwarfs. Ready, everyone? Will start. All right. So Wonderland Limited has excess cash of 20 lakhs. Wonderful. Okay. So they have got 20 lakh rupees extra cash which it wants to invest in short-term marketable securities. Expenses relating to the investment will be 50,000 and the securities will give return of 9%. The company seeks your advice. Point number 1, as to what should be the period of investment so as to earn 5% return. Okay, look at the screen. Question number 30, point number 1, can I say required return in rupees is 20 lakh into 5%. Basically, do you realize that we want to earn 1 lakh rupees on our 20 lakh? Everyone clear? Let number of months for which we invest be X. Now listen carefully. Can I say 20 lakh into, now this bond where we are thinking about investing the securities, they are giving us 9% return. So do you realize that 20 lakh into 9% is the return that we will get? I hope you are able to understand. But we are saying no, we want a return of only 1 lakh. Everyone ready? We want a return of only 1 lakh. Now 20 lakh into 9% is what? 1,80,000. Everyone clear? So that is very clear now that we are not wanting to invest for 1 full year. We are wanting to invest for less than 1 year. That's what they are asking you for how many months. Everyone clear? So do you realize this? into x by 12 I will do. Now I hope you are able to understand this. Into x by 12 I will do. I will be able to find the number of months. But then I remember that this return that I have, no, this is, can I say, pre-tax. Everyone clear now? I have not yet taken tax into consideration, but in the question anyways there is no tax, so ignore that point of tax. Moving on, do you realize that to do all of this investment, no, the expenses that I have to incur is 50,000. So do you realize that I have to incur these expenses, which means I want to earn this 1 lakh after incurring those expenses. Everyone clear? I want to earn that 1 lakh after incurring. So this is the gross income I will be earning. From that 50,000 I will be spending, and I need a net income of 1 lakh. So for that, how much period I should be staying in this particular bond is the question. Everyone clear? Okay. So please copy this and solve it. One of you is saying 10 months, one of you is saying 3.33. What is the answer? It is very simple. 1 lakh plus 50,000 into 12 divided by 0.09 divided by 20 lakh. 10 months. 10 months. 10 na? Sure everyone? Okay. Now students, in point number 2 they are saying how much period the company should stay in this investment. Now you will say, Arey, just now we calculated. They are saying no, I am asking to break even. Break even means, do you realize that I will say calculation of number of months we should invest to break even. Now for that, can I have the calculation will be 20 lakh into 9% into x by 12, the whole minus 50,000 equal to 0. Everybody, are you all able to understand how many months I should wait so that at least I come to no profit, no loss? Hey, do you understand? The answer has to be less than 10 months, because 10 months if you wait, you are going into profit. Hello, you are getting 1 lakh rupees profit. I want to know at least for zero profit, 0 loss, how much minimum I should wait. That is the question. Others clear? Bhavani? Sure? Okay. Please complete point number 2. The answer to this is 3.33 months. All done? Okay. Now in the notebooks, give heading module number 11. Module 11. Dirty and clean price of a bond. Dirty and clean price of a bond. Weird name, na? Dirty and clean price. Okay, let's start. So now, all right. So it'll take some time, but you'll understand. Don't worry. Okay. Let's say this is 12 months. Okay, 1 year. There is a bond whose face value is 1000. Ready? And let's say the current market price today is, let's say, 1200. Everyone ready? Current market price 1200. This is all happening at end of year 0. Coupon rate is, let's say, 12%, and so on. Now, let's say that Adarsh is the owner of one of these bonds or few of these bonds. Owner is already purchased in the past. Okay. Now, interest of rupees 120. Can I say Adarsh will receive at end of 12th month? This year's interest I am saying. Last year's interest he must have got here. You are understanding? Na? That's over. I am saying now coming year's interest he will get at end of year 1. Now, 9 months later, Adarsh has some emergency due to which he cannot wait any further in the bond. He wants to get out. Redemption will not be provided to him because redemption is not here. Redemption will happen after 5-6 years, whatever. So the only option he has is to sell the bond. Now when he decides to sell the bond, he will sell at the market price at the end of 9th month. Okay. Let's say the current market price here is 1000, maybe 310, for example. He sells it off for 1310 at end of 9th month. At end of 9th month, Divya enters the bond. What do you mean by Divya entering the bond? Because when Adarsh must have sold it, somebody must have bought it. Everybody clear? Do you realize you cannot sell your shares also if there is no buyer? You know, na? You cannot say, I will sell in the stock market. No, stock market is just a market. It is like Zoom. You cannot say, I'll go to Zoom and I'll learn. There has to be a teacher, no, on the other side. Or teacher cannot say, I'll go to Zoom and I'll teach. But if there is no student only who wants to learn from you, then whom will you teach? You're understanding? So, like that, do you realize that there has to be two parties? And there is the marketplace. Externally, it appears that we deal with the marketplace, but we are not. Like you will externally tell, I study on Zoom, but you are not studying on Zoom. You are studying from teacher. I am telling everyone, I teach on Zoom. I am not teaching on Zoom. I am teaching student. You are understanding it. Externally, it appears that marketplace is the counterparty, but marketplace is not the counterparty. Like for example, I sold my shares in National Stock Exchange. In NSC, no, I sold my shares. No. You sold your share to somebody else. You both came in NSE to meet each other. You're understanding, na? Marketplace is a place where buyers and sellers meet, like that. So here, can I say Adarsh sold, his bond, and Divya must have purchased it. Okay. Now, when Divya purchases this bond, she pays 1,310. Can I say she stays in this bond for 3 more months and she gets the interest of 120. Now, companies don't have time to figure out who was there for how many months. Whoever is present will benefit. So on the date of interest, Divya is there in the register, so Divya will get the interest. Now when you look at this, someone might wonder, so much partiality is happening here, so much injustice has happened to others. Everything is going in Divya's favor. 3 months only she is there and she is getting 12 months interest. So, others, what we should do? Men lives matter, no? So, do you realize we also should be, having some kind of dharna on the streets with placards and all, and we should say, no, give us our 9-month interest, correct, no? See, I will not be able to explain to you unless you understand the injustice first. You are understanding what I am trying to say? Solution can come only if there is a problem, no? So, the problem here is that others will feel cheated from the company's point of view. He'll say, company, you cheated me. I was there in your house for 9 months. I was supposed to be getting interest. Somebody walked in for 3 months and you're giving the whole 12 months interest to her. Everyone clear na story? Now I want you to think how Adarsh is wrong. He should not feel victimized. He should not feel cheated. He should feel everything is proper. Can you figure out where and how? Will you say, sir, he will call Divya and ask for 9 months interest? Students, others doesn't even know who Divya is. In a marketplace, we don't know who the counterparty is. They are just numbers on the screen. You're understanding? It is not Facebook or Instagram na, where you know who the counterparty is. It's a market. In a marketplace, they are just numbers, dots, electronic dots. You don't know who the party is. Yes. So 2 people have given the answer and both of them are given right. Yes. All of you are right. Students, others should not feel left out in life because FOMO. You should not feel FOMO because you know what is FOMO? Fear of missing out. He is missing out now on 9 months interest. He should not feel FOMO. Recently I heard one term called JOMO. You know what is JOMO? Joy of missing out. It is it is a good term for introverts like me. Joy of missing out. So nice term. So like that now others should not feel FOMO here. Why? Because others should be counseled that when you sold the bond to Divya at 1310, at that time the bond actually was not worth 1310. I hope you are able to understand. You sold it at an inflated price. And the inflation in that 1310 was caused by the accrued interest till that period of time. Can I say the accrued interest till that period of time is 120 into 9 by 12, that is rupees 90, which means in that 1310, 90 rupees is actually not the part only of what the bond's value should have been. It is still reflecting in the bond's value due to the accrued interest, and then the other bond's basic value should have been 1220. Everybody clear? It should have been 1220. So basically the price, the current market price is this. Hey, do you realize this price will never be seen in the market? The market price will be 1310 only. On paper, we are trying to counsel others who is crying right now out of injustice, out of seeming injustice which has happened to him, alleged wrong that has been done to him, but it has no wrong done to him. Do you realize that when he sold a bond, the bond that he sold was supposed to have a value of only 1220. He was able to sell it for 1310, which is where he recovered his 90 rupees. Everybody clear? No, he recovered his 90. When Divya hears this, she starts crying. She says, "Oh sir, that everyone is against me. Everyone is cheating me." I say, "Why you are saying like this?" He says, "Sir, 1220 bond it was. Why I paid 90 rupees more?" Now I have to counsel Divya that you should also not feel wronged, because you are getting full 120 after 3 months. Everybody clear? Whereas you deserve only 30 rupees. Because you stayed in this bond only for 90 days, for 3 months, sorry, everybody clear, na? For 3 months. I hope everyone is following. So you deserve 30, but you will be getting 90. So you are basically paying 90 rupees. I'm sorry, you deserved 30, but you are getting 120. You are understanding that you deserve 30, but you are getting 120. So the 90 which you don't deserve, you are paying that upfront. Everybody clear? That is the calculation. Now students, in this, this price is there, 1310. This is in accounting terminology called as cum interest price. And this basic value accounts doesn't have only, you are understanding, and in case it has, I'll tell you what it is called. Right now you understand this is cum interest. Now students, do you understand that on this date, on 12th month, the bond which is at 1310 will swell up further, I hope you are understanding, will swell up further with 3 more months of accrued interest into the price, correct? But the moment the company will pay interest, do you realize the bond price will fall down? Everybody clear? It will fall down by that much portion of the interest. The whole 1 year interest will go away, and then accounts calls that price as the X interest price. Everybody clear? There is a cum interest, cumulative of interest, and X interest. Everyone clear? The X literally refers to the X that you know. X means past. Your understanding gone. X interest. Everyone following? Sure. So let's say that on the 12th month, the current market price is 1340. For example, on the 12th month, the current market price is 1340. Immediately when the interest of 120 is given, the bond price will fall to 1220. Everybody clear? It will fall to 1220. This is a coincidence. This could be 1345 and the bond price could go to 1225. Everyone clear? Just random number I am taking, because demand, supply, YTM, all that will also play a role here. Just saying that on the due date, a bond will display both prices. It will display the cum interest also, and then as soon as interest is given, it becomes X interest. Now, why is it? What is the logic of the bond being cum interest? Because imagine students, what if others should have sold this bond on the 12th month, last day, just before the interest was supposed to be due? Just before interest was to be paid, others had to get out. Now you will say, how unfortunate can one be? Full 12 months he stayed, and Divya, how fortunate can you be? You are understanding? Because she will just enter, and she will get 120 rupees interest. You are understanding, no? But I hope you realize that's not the case. because when Adarsh is selling his bond, in that 1340 is recovering his 120 also. Everyone clear? When Divya is basically paying the inflated value of the bond, full interest is there. But the moment interest is paid, do you all understand, students? Now people like others need not charge 120. I hope you're understanding. The moment interest is paid, can I say the investors will get their interest? The bond price will now come back to 1225, come back to its basic value. Everyone clear? So students, in finance, if a bond price, whether it be at end of 9th month or 1st month or 12th month, if the bond price has an element of accrued interest in it, which means basically it is come interest, we in finance call it as dirty price of bond. Because the dirt of accrued interest is also there. It is not the clean price. Everyone clear? The clean price is basically calculated as dirty price minus accrued interest. Everybody clear? This 1220 here is the clean price. The 1225 up there is the clean price. Everyone clear? Once accrued interest you subtract, what is left behind is clean price. Can I say on due date, the clean price is visible in the market? You're understanding? 1345 becomes 1225. 1225 is the clean price. But the moment one more day, 2 more days, 3 more days happen, slowly dirt again starts accumulating. Everyone clear? Dirt in the form of accrued interest. This clean price of 1220 that I am showing you, that is, can I say, only calculated on paper. You cannot have this 1220 in the marketplace. Market price has to be 1310 only, because till the time interest is not actually paid, no, it will not transform from dirty to clean. Everyone following? That is the logic of dirty price and clean price. So we will just write down here, write down in notebooks. You given heading on dirty and clean price. Write down. Point number A, dirty price refers to cum interest market price of bond. Dirty price refers to cum interest market price of bond. Clean price equal to dirty price minus accrued or accumulated interest. That's it. Nothing more required. One 4-mark question is there in ICA module. It is there in your book also. That is question number 32. Now that is the only one left. 32. So please read the question carefully. 32. Ready? Okay. So here now, what has happened is bank A enters into a repo. So repo in my example, no, this is like HDFC Bank. Everybody clear? HDFC Bank is entering into a repo with bank B, which is like RBI. Everyone clear? RBI, Reserve Bank of India. For 14 days period in 10% Government of India bonds at 5.6% for 8 crores. My God, too much information given. Wait. Slow and steady wins the race. Not always. Okay. Listen carefully. See. I am saying that bank, HDFC Bank is there, no? It goes to RBI and says, RBI, I want to borrow from you for 14 days period. Story number 1 clear? I want to borrow from you for 14 days period. RBI says, no problem, I want deposit, give some securities to me in a repo agreement, which means once you repay the loan, I will give you back your securities. Everybody clear? Hello, remember the story, na? Hello, everyone there. Okay. Now, HDFC Bank says, okay, I have got 10% Government of India bonds 2028, in which the coupon is 5.65% and the face value of that is 8 crore. Everyone's story clear till here? So, therefore, HDFC Bank will hand over Government of India 10% coupon bonds. Yeah, just one information I just spoke wrongly. Sorry for that. Coupon rate I by mistake said 5.65%. Coupon rate in the Government of India bonds is 10%. Everybody clear? Coupon rate in the Government of India bonds is 10%. Then what is 5.65%? 5.65% is the interest that HDFC Bank has to pay to RBI for the 14-day period loan. Everybody clear? There are two interest rates here, no? So, the loan that we are talking about, who is borrowing from whom? HDFC Bank is borrowing from RBI. Everybody clear? Bank A is HDFC Bank, RBI is Bank B. HDFC Bank is borrowing from RBI, correct? RBI is lending to HDFC Bank at the rate 5.65% per annum. Story clear? This part is clear? For a period of 14 days, everyone clear? For a period of 14 days. That is the loan agreement. But because it is a repo, Bank B, that is RBI, is telling Bank A, that is HDFC, that I want security. Everybody clear? I want security. So you enter into an agreement where HDFC, you sell securities to me, I will buy it from you. See students, buying means, I hope you realize, when RBI is buying the securities from HDFC, RBI has to pay something, no? That what RBI is paying becomes the loan amount. Everybody clear, na? What RBI is paying becomes the loan amount, and then on the due date, reverse transaction will happen. You are understanding, na? Where RBI will then give those securities back, like a sell back. HDFC will repurchase and then give back the loan. But when so the question arises that when RBI is selling the securities back to HDFC, RBI will receive something, no? Because when RBI is selling the securities back to HDFC, HDFC is buying, na, repurchasing their securities back from RBI, HDFC will have to pay something. What is HDFC paying? Repayment of the loan. Everybody clear, na? Repayment of the loan is considered as the purchase or the sale price, along with the interest accrued at 5.65%. Everyone clear till here? Now, the question is, what is 10% here? 10% is the coupon rate of the securities that HDFC Bank is handing over to RBI. Everybody clear? Okay. And that, do you realize, is the coupon and the 2028 which is given. What is 2028 here? 2028, do you realize, is the maturity period of the Government of India bonds. It is not the maturity period of the loan agreement between Bank A and Bank B. Everybody, that is just a 14-day period loan agreement. All story clear till here? Hello, done? Okay. Now, assuming that clean price, that is the price that does not have accrued interest, is 99.42. Students, we will assume the face value to be 100. Everyone clear? Face value is to be assumed to be 100. Face value of whom? Of this bond, hello, Government of India bond. Sir, but you said it is 8 crore, no? Arey, 8 crore is the face value of all the bonds that HDFC is owning. Everyone clear, na? I am talking now of one bond. One bond is assumed to be having a face value of 100, correct? And its clean price is 99.42. Story clear till here? Clean price 99.42. Now they are, forget everything, they are asking you to determine the dirty price. Now, students, before we enter into details of this question, can I say that dirty price will be clean price plus accrued interest? This language, do you understand? Clean price plus accrued interest. Can I say clean price is 99.42? Everyone, are you all able to understand? 99.42 is the clean price. So I'll write here 99.42 plus. Now, accrued interest. Students, by the way, whose dirty price are we calculating? Government bonds. You're understanding now? Who is owning these government bonds as of now? HDFC Bank. Everyone clear? These very bonds will be then given to RBI for in exchange of loan. That is second stage. Right now we are just talking of the government bonds that HDFC Bank owns, which is having a face value per bond of 100 and having a clean price of 99.42. They are asking you what will be dirty price. Now dirty price, do you realize, will be 100 into the rate into the period by 365. Come on, first of all, are you understanding the setting here? 100, why 100 I took? Because 100 is the face value. Everyone clear? Into the rate into something by 365. I would be happy if you can tell me on chat box, rate I should take 10% or 14%. I want to know what is the dirty price of the HDFC bond. HDFC bond dirty price, I want to include the accrued interest. That accrued interest of that HDFC bond will be at the rate 10% or at the rate 14%. Everyone please participate. 4 people have given answer. All of you are right. 5 right. Anyone else is there on the 6 right? Anyone else? 7 right. Thank you. How come everyone is giving right answer? Nobody is having any doubt? If those whose videos are on, everyone has not given answer. What is happening? Some doubt you have? Please put what is the doubt on the chat box. Right. Anything you want me to ask again? You have understood the question? So everyone's message has not yet come. Okay, no problem. The answer is 10%. Correct? The answer is 10%. Since none of you have a doubt, you must be understanding this. Okay, next. The next question I want you to answer is how many days? Read the question now. Read the question. Should I take 14 days or should I take this 262 days? 14 or 262? Take your time. 14 days or 262 days? Yes, it is 262. Do you realize that that 14 has nothing to do with this bond? Everyone clear, no? Okay. So give me the dirty price, please. I am so sorry, one mistake I did. Hello, look at this. Mistake in a sense, one line we did not read. Consider 360 days a year. So if this is 360 days a year, then can I say 262 divided by 360? So whatever answer you got now, multiply by 365 and divide by 360. We'll get it. Now I am getting answers which I have been seeing in the past also. Correct. 106.7. I was getting answers, I was thinking, I have not seen this answer ever. Why is this answer not tallying with my history? Then I understood something. Okay. Done. 106.7 all understood. Okay. Look at the board. I'm sorry. Look at the screen. Okay. See. Do you realize this 106.7 is also the current market price. Please know 99.42 is a fictitious fictional number. You understand, 99.42 will never be seen in the market. In the market, the price is always dirty unless it is due date. You understand? On due date, the actual price, dirty price, clean price, everything is same. But as a rule, if you want, market price is always dirty. Everyone clear? Or it is only on due date that the due date also it is dirty price only. Just that dirty became clean for one day. You're understanding? Once a year it takes bath like that. Huh? Okay. Now, students, please understand. Can I say therefore, the current market price of all bonds owned by HDFC Bank will be 8 crore into 106.7 divided by 100. Before you pick up the calci, are you understanding what I have written here? 8 crore is the total face value of the bonds that HDFC Bank owned. Divide by 100 into 106.7, can I say will give you the total market value of the bonds that this particular company, this particular bank is owning, correct? So that comes to rupees 8 crore 53 lakh 60,000. Story clear till here? This is your point number 1, dirty price. So dirty price per bond we got 106.7. Dirty price of all bonds that that company owned is 8 crore 53 lakh 60,000. Done. Can I go ahead please? Okay. Now, the question before I show you point number 2, do you realize these bonds of 8 crore 53 lakh 60,000 market value, HDFC Bank will take and sell to RBI. Come on everyone. And RBI in return will give a loan of 8 crore 53 lakh 60,000. Story clear till here? So do you understand here that loan amount will be 8 crore 53 lakh 60,000 because that is the value of securities. But, hello, any doubt you have? All sure, na? But RBI is saying, like this cut to cut we will not be able to do, which means, 8 crore 53 lakh rupees 60,000 asset you are giving and that much only I will give you the loan amount. Na? That is not our policy. We will deduct a margin of 2%. Everybody clear? We will deduct a margin of 2%. So when you deduct an initial margin of 2%, that means the loan amount therefore comes to how much? Eight crore 36 lakh 52,800. Okay, 8 crore 36 lakh 52,800. Everyone clear? Students, therefore, this is the loan amount that HDFC Bank will receive from RBI Bank on the deposit of government securities worth 8 crore 53 lakh 60,000. Story clear? Students, do you realize this is at the rate 5.65% per annum for 14 days. Did you understand this language? This loan HDFC Bank is getting from RBI. Correct? at the rate 5.65% for 14 days. So can I say the maturity value, that is the repayment that HDFC has to do on maturity will be 8 crore 36 lakh 52,800 into, I hope you understand the maths, 0.0565 into 14 divided by 360. Is this number mathematically clear to all of you? Take your time understanding everything. Okay, then give me the number please. Eight crore 38 36 603. Everyone clear? 8 crore 38 36 603. Are you sure understood now what I wanted to explain? It is clear. If I look at ICAI's solution, this is their solution. 8 crore 38 36 604 they got. That's okay. 8 36 38 36 603 we got. It's okay. Done everyone. This is the full calculation. So we'll then give it to you. Please start copying question number 32, point number 1 onwards. Start. Clean and clear. All done. What is the market value of the HDFC bond on the due date is irrelevant, now. Only at the time of the loan it is relevant. Then only cash will exchange hands. That's it. Okay. So students, with that we finish the discussion to security valuation part B, correct? Money market instruments done, everything done and dusted. Now we will go to security valuation part A. We will start at 8:30. Acha, listen, at 10 o'clock, no, 10 o'clock, lecture is still what, 2 o'clock, no, hello. At 10 o'clock I will give you 15 minutes break. 10 to 10:15 we will take a break. Then 10:15 to 12 o'clock we will go again. 12 o'clock I will give you half an hour break. So that now in the break also we will feel happy about the break. 10 o'clock if I give you half an hour break, now you will be miserable in the break, you are understanding? So the later the break, na, the more utility is high, you are understanding? So 12 o'clock I will give, yeah, 12, 12:30, whatever, 12 o'clock I will give you the break. 12 to 12:30 you can have your lunch also, proper time. And but your lunch will be ready by 12? No. If no, then tell now only that 12 to 12:30 we are coming to attack. So, and then 12:30 to 2, 1.5 hours na we will go for the next session, like that. And then 2 o'clock, PG is no problem. Mess is in a mess. Anyways, so let's see. Anyways, what stops you from having lunch anyways? Lectures? Lol. Correct? You will anyways have it whenever it comes to you. So I will give it at 12. Okay, thank you. So now relax for 2-3 minutes and we'll start new chapter.